All right, we are looking at a soft start for stocks, continuing the selling pressure that we saw last week. I want to get more on what's happening in the markets now from Jack Manley. He is a global market strategist at JP Morgan Asset Management. Jack, it's great to see you. And what do you make of what's happening in the equity world right now?
Well, you know, John, we're of course heading into the end of the quarter, and I think you're probably seeing a little bit of profit taking going on at the moment. But much bigger is the macro backdrop that we are staring down. You know, we have a very contentious auto worker strike in the U.S., a looming government shutdown, which should happen as soon as October 1st if things don't work out the way that they are supposed to. And of course, a Federal Reserve that frankly surprised me a whole lot last meeting by being a lot more hawkish in its discussion around policy looking forward. Investors are just dealing with all of these things, and it doesn't particularly surprise me that we've seen some downward pressure on prices over the last week or so. You know,
we were telling that story through the bond market earlier in the program, the fact that that idea of higher for longer, they're pounding the table in the bond market. You've seen multi-year highs for, let's say, the 10 and 30-year Treasury. Can you explain to our audience, if you're trying to look at bond yields and figure out what that means for the temperature in the stock market, are there key levels to watch for? How are you looking at that?
It's difficult to sort of put a fine point on exactly what that tipping point may be in terms of interest rates impacting the equity market. But I would say two high-level things to keep in mind when you're looking at how yields shape the view of stocks. You know, one of them is going to be that the hurdle for return is that much higher, right? In the world where bond yields are basically zero, there is no alternative. It's that TINA trade that we spend so much time talking about for the better part of the last 20 years. Now that bonds actually do have a coupon, you can actually make some decent money off of fixed income. You're going to have to take a closer look at equities and be much more selective about how you allocate that capital. The other thing, though, to take into consideration, John, is that, you know, we spend a lot of time talking about duration as it applies to fixed income. Duration can also be applied to equities, and the U.S. equity market is a high duration stock market because so much of it, as you mentioned a little bit earlier, is dependent on technology and tech adjacent names. These are companies that may not necessarily have proven track records of high quality, consistent earnings. They may be companies that are a little bit more speculative, have an idea that they are promising to you not tomorrow or next month, but over the next 5, 10, 15 years. And those companies are going to benefit disproportionately from lower interest rates because borrowing costs will be just that much lower. With rates looking higher for longer, that challenges the narrative for those high growth tech and tech adjacent names, and in turn, the broader equity market.
Now, I guess just playing devil's advocate here, you had such a positive mood in the markets for much of the year. Mind you, I know, to your point, that is extremely skewed by the fact that tech stocks had big returns. There's a lot of sectors that had mediocre performance. But nevertheless, people felt pretty good. They kept talking about this idea of a so-called soft landing. History would suggest that if you're having a good year and then you see some bumps in, let's say, August and September, you still tend to find some buying interest in the market in the tail end of the year. And then the other factor here is I don't hear anybody who's saying, well, we're going to see a huge number of interest rate hikes from here. Just the path is clear for that. I hear, you know, maybe another Fed move higher for longer. But I think a lot of investors had also been waiting for the end of the rate hike cycle because there is some good historical evidence that suggests that actually becomes a somewhat positive stretch for the stock market. So how are you balancing all of that?
So I would say it's not so much about the absolute level of rates, John, as it is about the rate of change and the direction of travel. So, yes, you know, we are looking for an end of this hiking cycle, but what everyone is really paying attention to and looking for is that ultimate pivot. We have to remember that from the beginning, one of the only things the Federal Reserve has consistently told us is that wherever it lands on interest rates in this hiking cycle is not where it's going to stay forever. I'm getting a little spooked by Fed policy announcements from last week because it almost feels to me, John, like the Fed's lost the plot. You know, it acknowledged in its new summary of economic projections that inflation is going to be in better shape this year and likely next year than it had anticipated at its last major meeting back in June. Why they would translate that view into the need to cut less next year and cut less in 2025, I think is frankly baffling. Every second that the Fed keeps rates elevated at this level is an increased risk to blowing up this so-called soft landing. And I think that that's why everybody's been so concerned and why last week's announcement really put so much downward pressure on prices in stocks.
Okay, I want to come back to Canada versus the U.S. because this hour we started with a guest who was very bearish on Canada's economy. The fact that we already have highly indebted households, that mortgage rates are already squeezing a lot of Canadians, that this continued upward pressure on yields, regardless of what the Bank of Canada does, is going to keep those households feeling stretched. People less able to basically pay the principal on their mortgages, and painting a picture for the Canadian economy which is different than the U.S. economy. You got a view on that?
I think as within the U.S. And in Canada, we are talking about a story here of kind of towing the line. This is a very, very difficult position for central banks to be in. You know, as you mentioned, John, the Canadian housing market is significantly more sensitive to higher interest rates, not just because it is a bigger portion of the overall economy than it is down here in the States, but also because mortgage terms are a whole lot different. You don't sign 30-year fixed-rate mortgages up in Canada, so the impact of those higher rates are coming through so much more quickly. I do think there is some risk to the Canadian economy, and we've seen some disappointing GDP prints, particularly for the second quarter relative to consensus expectations. The real question here is, does the Bank of Canada have to follow the Federal Reserve in being a little bit more hawkish? My guess is they may be forced to be. And if that is the case, then I would say the macro outlook for Canada over just the last week has deteriorated a little bit. I am a bit concerned. A
final question, not to confuse our audience too much, but then there's the oil consideration. And last year, when oil was rallying, that gave Canada a chance to outperform when you saw tech stocks taking a real hit. First half of this year, well, we know that story. Oil was generally under pressure. Tech stocks were roaring ahead. Since the start of the second half, energy stocks in Canada and some of the names in the U.S. have done relatively well because of this momentum for oil. But again, if we're talking about an economy which will increasingly feel fragile, you have to wonder, what does that mean for oil demand? I know everybody talks about the supply picture, but I guess it's a twofold question. What's your outlook for oil? And subsequently, what does that mean for energy investors?
Well, I would say, you know, John, while the outlook for Canada, I think, has deteriorated a little bit, the U.S. economy still seems to be remarkably resilient. And as the largest consumer of oil on the planet, I think that that's where the consumption story really matters. But to your point, right, this is so much more of a story about supply relative to demand, and supply chain issues can always be fixed. They always do get resolved. In this case, my guess is it translates into increased U.S. energy production. A lot of people don't realize this, John, but the U.S. is on track to produce more energy this year than it ever has in history and will produce even more in 2024. All of that fuel flowing out there should help to keep a lid on prices. How that translates into the outlook for Canada means that, well, if energy prices don't keep on rising as they have been recently, I think the positive impact there may be a little bit muted going forward.
Okay.